In today's episode, we'll break down two important stories. First, we'll talk about how high SpaceX can fly, and then we'll talk about how Indian carmakers performed this quarter. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host, Akshara. Today is Tuesday, 26th May. Coming to the first story. It's hard to know what one should make of SpaceX's IPO filings. It is, above all, a picture of extremes. So here's a sample. This January, the SpaceX board granted founder Elon Musk 1 billion shares of Class B stock, which would vest in 15 tranches as the company's market capitalization would rise. This isn't unusual in itself. Musk would get similar performance grants at Tesla as well. But what's new was a condition. For any of those tranches to vest, he would have to ensure a permanent human colony on Mars with at least 1 million inhabitants. A different grant from this March could give him another 300 million shares. But those would partly vest once he managed to fly a data center with 100 terawatts of compute a year to space. That's roughly 100,000 times what SpaceX has installed today. Last year, the same company burned through $14 billion of cash, and its debt alone comes to $30 billion. Its capex bill last year was thrice as large as its actual earnings. Now, this isn't a normal company. It's one built on both ambition and hubris, both of stratospheric proportions. And now they're aiming at the world's largest ever IPO as well. Their recent IPO document gives us a rare glimpse into the business beneath the madness. Now, we aren't sure if we comprehend SpaceX any better because of it, or if our confusion just runs deeper now. Either way, here's what we saw. So SpaceX, despite its name, isn't merely a space business. It's a hazy amalgamation of many futuristic enterprises. Now, its original heart was launch, the business of sending things up to space. SpaceX is the world's biggest spacefaring entity, more prolific than all the world's sovereign space programs taken together. In 2025, 4 out of every 5 kilograms humans sent to space went there on a SpaceX rocket. Now, the workhorse of its launch program is one of the greatest engineering marvels of the modern world, the Falcon 9. The rocket has flown over 620 orbital missions with a mission success rate of over 99%, the highest of any launch vehicle in the world. The rocket and its reusable boosters fundamentally changed space travel. Before it, sending a single kilogram of payload into orbit cost $18,500. Once the Falcon 9 was pressed into regular service, that fell to just $2,700. There's simply nothing else like it. So SpaceX counts everyone from young startups like India's own Galaxy to NASA among its customers. But as the company matures, its bigger customer is turning out to be SpaceX itself. In 2023, about 2/3 of all Falcon launches catered to SpaceX. But by 2025, SpaceX's payloads occupied almost 3/4 of the Falcon's launches. So why does SpaceX's internal demand ring this strong? Why does the world's most powerful launch platform increasingly cater to itself? Increasingly, the heart of SpaceX isn't space launches. It's the internet. Over the last few years, SpaceX has created a constellation of thousands of tiny satellites that beam the internet across remote parts of the world in a service called Starlink. By the March quarter this year, the service had 10.5 million subscribers across 164 countries around the world. It was used by both sides in the Russia-Ukraine war, and when Russians were cut off from the service, it changed the tide of that war. And it's currently being smuggled into Iran to get around the country's internet blackout. Now, a service like this is only possible because of Starlink's 9.5 thousand satellites, or about 3/4 of every active satellite in space. This is increasingly the main cash cow of SpaceX. Starlink revenues netted the company $11.5 billion in 2025, or nearly 3/5 of the company's overall income. This is the only part of the SpaceX business that generates any meaningful profit, with last year's EBITDA coming to $7.2 billion. But how many customers will pay for satellite internet though? The company is currently fanning out across the developing world, looking for customers everywhere, from Kenya to Indonesia, to add to their service. This has, however, materially decreased their per customer earnings. So their average revenue per user, or ARPU, used to be $91 a month back in 2024. By the March quarter this year, it had fallen to $66. And the company assumes that it'll keep falling until it settles at $31. So, can the company's economics of scale handle such a fall? Now, the company needs something to sustain its cash flows because a new addition to the SpaceX family is burning up all the money it can make. So, this February, SpaceX absorbed XAI into its business, a short while after XAI had, in turn, absorbed X, which was formerly Twitter. And both businesses now sit on the spacefaring entity's books. The merger was an odd moment for the company. On the one hand, it had acquired another major futuristic business. At the same time, though, the company inherited a tangle of related party arrangements and a lot of the controversies Elon Musk was associated with. Now, the new business came with $3.2 billion of revenue from 2025. Twitter advertisements alone brought in $1.8 billion in 2025. And then there were subscriptions, data licensing, and developer access to Grok's models, which collectively brought in $1.4 billion last year and are growing twice as fast. But for every dollar it was bringing in, it was losing too. The company ran at an operating loss of $6.4 billion. And on top of that, it spent $12.7 billion in capital expenses, roughly 4 times revenue, in building out data centers and acquiring GPU clusters at industrial scale. Its margins have been falling while depreciation alone has overtaken the segment's earnings. But the company thinks of itself as essentially building for a distant future. So, there are signs that this calculation isn't entirely far fetched. Just a few months ago, XAI was in an ugly public feud with Anthropic. It was only this January when Anthropic had banned XAI engineers from using Claude, supposedly because they were using it to build their own models. In February, Elon Musk called Anthropic misanthropic and evil. But just 3 months hence, the companies are now partnering. Anthropic recently announced it would lease the entirety of XAI's first Memphis data center called Colossus. It agreed to pay XAI a staggering $1.25 billion a month through May 2029, roughly $40 billion over the life of the contract. In other words, a direct AI competitor with whom XAI had a publicly strained relationship just decided to rely on it as an infrastructure provider. And for that, it agreed to pay an amount higher than most public companies' revenues every single month. Now, the AI business is currently in an economic wild west, one where all bets are off. XAI might not lead this race, but it's very much in the arena. Together, this gives us 3 very different businesses, all of which move at very different speeds. Collectively, their revenues have been growing rather quickly, from about $10 billion in 2023 to nearly $19 billion in 2025, most of which was driven by Starlink. And in 2025, they threw off nearly $7 billion in cash. But for all the hype, there's a genuine business here. But it's a business that's investing ungodly sums of money in the future. In 2025, its total capital expenditure was thrice the cash it actually made at $20.5 billion. Nearly $13 billion of that went into AI data centers alone. And then in just this March quarter, it spent another $10 billion, a lot of which was again in AI. That effectively gives the company deeply negative cash flows. The business burnt $14 billion in cash last year and has already burnt another $9 billion this year. So where did that money come from? It was raised externally. So SpaceX raised about $26 billion of financing in 2025, most of it debt for AI infrastructure. And another $7 billion came in this March quarter. This is adding up to a serious amount of debt on the company's books, more than $20 billion of which matures next year alone. The company will also have to pay out an extra $20 billion next year in contractual commitments. Now, under the terms of one of the major bridge loans SpaceX took out this year, the net proceeds of the company's IPO would first go into paying that loan. Contractually, this is what the IPO must do before all else: reduce the company's debt burden. Any new growth comes after that. This is the company that could launch the largest IPO in the world, an audacious but cash-hungry mix of businesses straight out of Star Wars. The IPO could bring in over $70 billion, valuing the company at over $2 trillion. That's roughly the amount of economic activity the entirety of Australia sees in a year. So what could ever make a business worth this much? The promise of SpaceX, by and large, lies in the future. The company's filings claim that it has identified the largest actionable total addressable market in human history. So, in all, the company frames itself as chasing a $28.5 trillion opportunity. Most of that, $26.5 trillion, comes from AI alone. In comparison, space exploration, which gives the company its name, is a relatively small $370 billion market. Is there a world where the company could get to even a fraction of that? So it spins together a captivating dream. In the vision itself, its newest rocket, Starship, which is almost twice as tall as Falcon 9 and can carry 5 times as much, will run at the same frequency as Falcon 9 currently does. This will enable a whole new paradigm. One where it'll run entire data centers in space, manufacture new satellites on the moon, and establish a permanent presence on Mars. If that vision sounds fanciful, it is. But it depends on a lot of things going exactly right. So, Starship, which is yet to deliver its first payload to orbit, will have to replicate the Falcon 9's incredible economics. It'll have to get around regulatory tussles while dodging political controversy and sovereign preferences, and meanwhile, its other businesses will have to fall into shape. Starlink will have to expand faster than its ARPU drops, while its AI arm will need to see more cash flow in. And its founder, who's also building cars at Tesla, brain chips at Neuralink, and tunnels at Boring Company, will have to get through all of it. This is a tall order, and it isn't a dream most people would agree to underwrite. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the second story. A decade ago, buying a car was a much simpler decision. You picked petrol or diesel, chose a hatchback or a sedan, and negotiated the best price with your dealer. Today, you're choosing between petrol, CNG, hybrid, and electric. Your neighbor might talk highly about CNG for the lower running cost. Your colleague just bought an EV and will not stop talking about it. And few might think anything without a diesel engine is a waste of money. And somewhere in all of this, you're trying to figure out what actually makes sense for your life, your commute, and your budget. That fragmented demand is visible in the Q4 FY26 results of India's three largest passenger vehicle companies, Maruti Suzuki, Hyundai India, and Tata Motors. Everyone sold more cars, but who's buying them, what are they buying, and what it costs to make those cars, that's where the real story is. So Maruti Suzuki posted net sales of rupees 50,079 crore on 6.7 lakh units sold, up 11.8% in volume. EBIT came in at rupees 4,409 crore, up 30.4% year-on-year, its strongest operating quarter ever. But net profit fell 6.9% to rupees 3,591 crore. But that wasn't because of the car business. Maruti incurred a paper loss of approximately rupees 750 crore on its non-operational financial investments. Now, Hyundai Motor India reported revenue of rupees 18,916 crore on 2.08 lakh units, up 8.7% in volume. But EBITDA margin dropped from 14.1% a year ago to 10.4%. We'll come back to why that happened. Tata's India passenger vehicle business crossed 2 lakh units in a single quarter for the first time. Its Q4 revenue was up 49% year-on-year to rupees 18,742 crore, while EBITDA margins were at 9.4%. But its volume surge also came off a weak first half of FY26 or H1 FY26 when the GST cut had not yet landed and Tata was still rebuilding momentum. At the Tata Motors passenger vehicles consolidated level, net profit fell 32%, mainly because of the cyber attack on Jaguar Land Rover and US tariffs. So in our last results story, we covered the GST cut, which propped up demand meaningfully enough to offset rising costs elsewhere. But this quarter, the cost side only worsened, and the West Asia conflict added another layer of pressure. For Tata, the cost of raw materials, steel and aluminium had gone up by more than 5% of revenue over the past year. So put differently, for every 100 rupees worth of cars Tata sold, more than 5 rupees extra went to raw materials than the year before. About 2 to 2.5% had already hit in FY26, and a steep additional 3.5 to 4% increase was coming through this quarter. What's more, Tata didn't pass any of the rising costs to consumer through all of FY26. So the logic behind it was this. Demand was fragile in H1, and in the second half, the company did not want to undercut the consumer benefit of the GST cut. So it absorbed the entire hit internally through cost reduction of approximately 2% of revenue. But that still left a gap. So going forward, they might end up passing some costs. But if that happens, it'll have to be done carefully without disturbing consumer value. This is as delicate as a balancing act can get. Meanwhile, Hyundai's response to rising costs was somewhat opposed to Tata. Commodity inflation ate about 1.2 percentage points off margins in a single quarter, and Hyundai actually passed on costs multiple times through the year, with one more flagged for May. It also tightened the discounts that dealers could offer buyers. And when demand is weak, car makers allow larger discounts to sell more. But after the GST cut, Hyundai pulled those back. But despite all of that, Hyundai's EBITDA margins fell by 4 percentage points year on year. But that's also because, on top of rising input costs, their new Pune plant was adding fixed costs before being fully operational. Additionally, a one off labor code provision pushed up employee costs by nearly rupees 100 crore in the quarter. Now, Maruti looked the least squeezed operationally. It actually made more money per car than it did the previous quarter, partly because it gave smaller discounts and partly because of favorable currency movements on exports. But they had deliberately not raised prices because they didn't want their sales momentum to slow down, a successful balancing act in terms of pricing. Interestingly, Maruti's belief is that the West Asia crisis is temporary, and once it's over, many of these cost pressures will lapse. They're taking it as part of regular business, a riskier approach compared to other companies. So costs went up and pricing alone could not fully cover the gap. But margins did not entirely collapse either. And that's because car makers sold more premium, higher margin models. For Maruti, the share of first time buyers jumped from about 42% in the first half of 2025 to 51% in Q4. Many were two wheeler owners upgrading to their first car after the GST cut made entry level models more affordable. But these new buyers did not behave the way first time buyers used to. A decade ago, the first would probably be an Alto. In 2026, the best selling car is the Desire, a sedan. The Victoris, a mid SUV, reached 50,000 sales faster than any Maruti model before. Most importantly, a 9 lakh rupee Desire earns the company more per unit than a 4 lakh rupee Alto would. Now, Hyundai's growth came from rural India and CNG car models, and there are reasons for both. Firstly, rural incomes have held up through good monsoons and government transfers, and Hyundai is deliberately putting 7 out of every 10 new outlets in rural areas. Rural penetration notched up from 22.6% in Q1 to 24.7% in Q4. But the CNG push is not just about offering another fuel option. In many Tier 2 and Tier 3 towns, CNG refueling infrastructure has expanded, making it more practical for buyers. CNG share in Hyundai sales went from 13% to 18% year on year. And this isn't just in rural areas. Urban demand also turned positive at 7% growth this quarter after being negative in H1 2026. Now, in Tata's case, its compact SUVs Nexon and Punch were the top sellers. CNG and EVs together now account for over 40% of Tata's portfolio. Across the board, the picture of the premium mix driving growth is largely similar. But the skeptical question is whether this mix shift is durable. If the GST-led first-time buyer wave fades, the mix could shift back towards lower margin models. Even if the premium mix stays, how long does it cushion against elevated commodity costs? That is where the supply side becomes important. So last quarter, we talked about order book swelling, but factory capacity falling painfully short of fulfilling them. That constraint now has a concrete response. Maruti, for instance, is commissioning 2 plants simultaneously, adding 500,000 units of capacity in a single year, which management called virtually unheard of. Meanwhile, Hyundai's Pune plant is running at 1.3 to 1.4 lakh units in 2 shifts, with expansions taking it to 3.2 lakh units by 2030. But Tata's problem is different. It's not short on factory space, but the Tata Sierra, which has seen strong bookings, is stuck because its casting suppliers for the new engine cannot ramp up fast enough. So Tata is bringing in additional suppliers to plug the gap. Now, beyond the quarterly numbers, there's a longer term question that all three dealt with. What kind of cars should companies be building for the next 5 to 10 years? Of course, in business, this question is inescapable. But one reason it's become harder to ignore now is the recently finalized CAFE3 norms, which cap the carbon dioxide emissions a car maker's entire fleet can emit on average. If you sell mostly petrol cars, the average of your fleet gets too high compared to what the norms allow. You need more CNG, hybrid, or electric cars to bring it down. So the CAFE3 norms are stricter than their predecessor rule set. If companies do not bring their averages down in time, they face three choices. They either face penalties, or they have to restrict how many petrol cars they sell, or they cross subsidize green vehicles by charging more for petrol modules. So, in that context, each company is playing a different long term game. Tata, of course, is the largest four wheeler EV player in India with over 40% market share and 92,000 units sold in FY26. They expect the cost of making petrol and diesel cars to only go up because of tighter norms, while EV costs will keep falling as batteries get cheaper and production scales. In fact, CEO Shailesh Chandra went as far as saying EVs will not just reach price parity with petrol based cars, but also become more profitable eventually. Now, Tata's EV bookings actually jumped 25 to 30% after the West Asia conflict began, as fuel uncertainty pushed more buyers to consider charging at home. What remains to be seen is how much of a structural force this is. And there is the possibility that if petrol stabilizes, some of that demand could fade. Hyundai is confident about meeting the CAFE3 threshold as well. But it isn't going all in on EVs the way Tata is. This year, Hyundai is launching its first localized electric compact SUV space alongside a new petrol based mid SUV. But it also leans heavily on CNG, which already accounts for 18% of its sales and helps bring the fleet average down anyway. For Hyundai's, EVs are just one among many green options. Maruti's first fully electric car, the e-Vitara, has begun production in Gujarat. It's also building a charging network targeting over 1 lakh points by 2030 to support the model. But Maruti also noted that the final CAFE3 draft is not yet notified and that it encourages all green technologies, not just EVs. That is why, much like Hyundai, EVs are only one part of Maruti's roster, which also includes biofuels, flex fuel readiness, CNG, and strong hybrids. It's making sure it has an answer no matter which way the market goes. And there's no answer to that yet because the nature of growth of each green technology is quite different. For instance, we know that rural India and CNG are among the fastest growth drivers right now. But at the same time, public charging infrastructure in Tier 2 and Tier 3 towns barely exists. The household buying a CNG car in a small town and the household considering EV in a metro are two very different buyers. Building for both at the same time is particularly expensive. First, pricing power. Hyundai raised prices in May, Tata took its first increase in April, and Maruti has announced hikes from June. The GST benefit is still fresh in buyers' minds. Q1 of FY27 itself could tell us how much of this demand recovery can survive a cost pass through. Second, plant utilization. New plants carry fixed costs whether they run at 50% or 90%. If demand holds, these investments pay for themselves through scale. Otherwise, they become a drag on margins. Third, EV traction beyond early adopters. So Tata is furthest on this curve. But in contrast, both Hyundai and Maruti have more calculated bets. And we are still in the midst of finding out how different green technologies in India will progress. Now coming to the tidbits. Tata Electronics plans to start semiconductor chip packaging at its upcoming OSAT facility in Assam, initially serving automotive and industrial clients. The company is fast tracking operations to prove manufacturing capability early, with the plant expected to scale up sharply by year end. Coming to the next tidbit. The government is considering extending the PM e-Drive scheme with fresh funding to continue supporting electric two-wheelers. Officials are looking at higher subsidies as India pushes electric mobility to cut dependence on imported oil and accelerate EV adoption. Coming to the final tidbit. The government subsidy expenditure could overshoot budget estimates by nearly 50%, mainly due to rising fuel costs and fertilizer costs linked to the Strait of Hormuz crisis. Higher LPG and fertilizer subsidies may significantly increase fiscal pressure if energy prices stay elevated. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.